Good morning, everyone. My name is Mary Zhang, and I'm a director on the Mining and Metals Investment Banking team at National Bank. I'm pleased to be your conference moderator this morning. Now, please help me welcome Hatham Hodaly, Senior Vice President of Corporate Development at Wheaton Precious Metals, for a fireside chat. So, Hatham, for the audience, can you talk a little bit about Wheaton's business model for those who might not be familiar?
Sure. Wheaton is a company that's been around for about 21 years. We are effectively a provider of financial capital to the mining industry. So what does that mean? We're a streaming company. So in streaming, what we do is for an upfront payment, we get a percentage of the production that's coming out of the mine, and we make an additional payment at the time of delivery of each of the ounces. Basically, we're a silent partner that provides capital to these companies that allows them to grow either their development stage opportunities, strengthen their financial positions, repay debt, whatever it may be they need the capital for. And we try to find the best assets to do that with.
Very nice. And we had Gary on stage last year, and when he was here, he mentioned that you guys had a 17% IRR on all of your acquisitions. Can you tell us a little bit about how you guys achieve that?
Sure. And to Gary's credit, Gary was a very integral part of that overall success. So we thank him. He recently did retire. I will say it all goes back to our disciplined approach to capital allocation. Not every stream is a Wheaton stream. We truly look for the highest quality assets in the marketplace. We look for an ability to provide capital to these long life, low cost operating mines. We focus on assets that fall in the lowest half of the cost curve. We structure streams such that we are protected, such that if there's any delays, we basically have compensation ounces paid to us, et cetera. And we participate in all the exploration upside as we structure life of mine streams. So that gives us the ability to, throughout over the life of the asset, and no single mine ever comes into production on time, on schedule, on budget. They're almost always delayed. But the mechanisms we've actually put in place help protect us against that, and that helps us garner that 17% return over the last 21 years.
Nice. And I saw in your
annual return.
Yeah. Of course. And I saw in your presentation that as of this year, you guys have now earned more capital than deployed in upfront payments. Can you discuss the significance of that?
Sure. So since Wheaton's inception, we've committed approximately $12.5 billion to help fund projects and advance projects and repair balance sheets. We've actually deployed approximately $10.5 billion of that, and as of I think it was 2024, we've recovered $10.5 billion. Now all that with still in our existing portfolio, we've got 27 years of reserves, we've got 14 years of M&I, and we've got another 23 years of inferred on top of that. So we still have 65 years of overall mine life. That's if we do absolutely nothing at this point in time. So it's actually been a very, very successful model.
It's a very impressive track record. And Wheaton now also has the mantle of the largest streaming and royalty company out there. And you guys are generating significant free cash flow. Can you tell us how you think about deploying that free cash flow into new acquisitions versus returning capital to shareholders?
Sure, and maybe I'll go back and talk a little bit about what we've done. Just let's take the last decade as an example. We've managed to deploy approximately $900 million a year on average. Now we've been generating, call it, $1 billion a year. We paid out 25 to 35% of that as dividends over the last decade, and we're continuing to find opportunities to invest. We look at probably 60 to 70 different opportunities a year. If we walk away with one or two, that's really where our focus is. We try to pick the best of the best. Not every opportunity, as I said earlier, is an opportunity we want in our portfolio. We've got 18 operating mines. We've got 28 development stage projects. We've got 33 different counterparties. So there's 33 different countries with opportunities for us to continue to expand and grow that. So our first objective is to actually invest back into the ground. That is our objective. And we would like to continue to help companies expand and grow their existing asset base. Now, we're generating this year we're sitting on $1 billion in cash as of the end of the last quarter. We're generating close to $1.4 to $1.5 billion in free cash every year before dividends. If for some reason we can't deploy that capital, we will look to increasing our progressive dividend to actually give that back to shareholders. Last year, we increased that dividend by about 6.5%, and we would expect something not too dissimilar next year as we move forward. So we have been very successful in deploying that capital, and that's the way that we feel we bring the most value. So that'll be our first objective, redeploy that capital into assets in the mining industry.
Okay, and on that front, how are you seeing deal flow in the sector?
Well, I run the corporate development team right now, so it has been an interesting time. The last couple of years, as I said earlier, we've managed to transact historically on 1, 2, 3 opportunities a year. Last year we did 4. The year before that we did 8. The year before that we did another 5 or 6. So we've had a very, very strong run over the last few years. We are seeing significant opportunities to fund development stage growth. And the big problem, what we've seen is the North American banks and even some of the European banks have not been there for these single asset development stage opportunities. So what happens is those opportunities end up going to private equity, et cetera. We've seen an ability to come in and actually provide funding to a lot of these earlier stage opportunities over the last few years. And that has enabled us to actually help these companies grow, but also help our near-term growth profile as well. We can talk a little bit more about that after, but so if you look at where we're actually going with our existing portfolio, we're very excited about the ability to actually continue to grow these assets.
Okay, and as you mentioned, there's more opportunities in the development asset space. And I think what we've seen in the last couple of years in the stream and royalty space is that the streamers are also starting to provide full financing packages and stepping outside of maybe just the stream.
Yeah.
What are your thoughts on that, and do you see that trend continuing, and are there any other trends that you think are going to surface in the sector?
Sure, and not every opportunity is going to be an opportunity where we feel comfortable enough fully financing a project. Sometimes it's good to diversify the risk that comes with these opportunities. However, that being said, we recognize that there's an opportunity to realize greater returns for our shareholders by putting in things like, other than the stream, putting in things like debt, cost overrun facilities, working capital facilities, or even in some cases equity. Last year was a perfect example. Last year we invested in 4 opportunities. 2 of them were fully funded transactions. One, we came in for Montage Gold and put in $625 million, and then a $75 million long-term debt facility. And that basically fully funded the entire project. That was an opportunity we were very excited about. The economics looked great in an environment which looks very, very, very promising for them from a future perspective, especially with regards to exploration in and around the existing assets. The other one was Rio 2 with the Phoenix project, where we came in and actually provided the remainder of the funding, another 100 out of a total of $150 million total that we funded over the last few years as well. So we're seeing an opportunity to continue to look at those type of funding packages. As I said, not every package, not every opportunity we would do this for. It really is the best quality assets out there that we see. We're looking for assets that fall in the lowest half of the cost curve. We're looking at 83% of our current production comes from assets that fall in the lowest half of the cost curve. We're looking for long life assets that and I'll go back, when they fall into the lowest half of the cost curve, even in a declining commodity price environment, those are the assets that our partners, the counterparties, will invest back into first. And those are the ones that we want to be involved with. So.
Right, okay. And in maybe 5 minutes, can you summarize for everyone why anyone in the audience today should buy Wheaton shares?
Sure, So Wheaton is, as you said earlier, it's the largest streaming company in the world. We're the 3rd largest precious metals company in the world. As of earlier this week, we were probably the 10th largest mining company in the world. We have organic growth, almost 40% growth in the next 5 years. That's growth from existing projects that are being developed. We have 7 projects that are actually up that will be adding to our existing cash flow profile. So our cash flow profile will go from, if you assume constant dollars right now, 1.4, 1.5 billion to over $2 billion in the next 5 years, with us doing absolutely no additional transactions and with no increasing in commodity price whatsoever. We have a focus on high quality assets, and that's definitely a key for why people should look to Wheaton for investment. We are not only looking to grow, we're looking to add shareholder value, and that's the key. We're not going to grow unaccretively. Everything we do has to be accretive. We've had opportunities over the last, I would say, last 5 years where we've had opportunities to do additional streams with our existing partners, but the margins on the assets they wanted to do them on just didn't work for us. And we don't want swing producers. We want assets that will constantly generate strong cash flows for our peers. We're currently sitting on $1 billion in cash flow, and we want to continue to accretively deploy that into the market. If, as I said earlier, we can't do that, Wheaton will continue to give that capital back to shareholders. So with over $2 billion in potential cash flows over the next 5 years, and that's 40% growth in the next 5 years, not even counting what happens past that, we still have another 21 development stage projects that will over time continue to actually come online. So, we're going to continue to grow this business, we're going to continue to grow this company accretively, and focus on the highest quality assets with the best counterparties in the world, and try to continue to build up on the success that we've actually had over the last 21 years.
Nice. And I guess in terms of future growth and evaluating new opportunities, your role, focused on corp dev. Given the gold price dynamics right now, with spot just under 3,400 an ounce, and long-term consensus being, materially lower, there's a huge gap right now. I think long-term is sitting around $2,400 an ounce. How do you guys think about that dynamic as you look at new investments?
Sure. The reason streaming works, and I would say almost 60+% of our production comes from, we're 99% precious metals revenues, and that's a big difference between us and our counterparties. The reason streaming works is because we take precious metals out of a base metal company that's typically trading at a significant discount to its net asset value and put it into our story. And because we do that, we're actually able to pay more capital, somewhere closer to NAV, for these assets, for these streams that we put into place. Whereas our partners, their counterparties that we actually are transacting with, would never actually see that unlocking of that value. So when we're actually looking at precious metals pricing, no, we're not using spot pricing, obviously, right? This is not to say that we're not very optimistic long term on commodity pricing, because we are. But obviously, it makes sense to use something in between spot and long-term consensus pricing. And the trick is to pay NAV for these assets, so it's a win-win situation. Wheaton will actually recognize the re-rate from its existing multiple, and the other counterparties will also have a successful re-rate because of the actual unlocking of the precious metals.
Okay, and I think some of your peers have started to look at, sector consolidation as an avenue to grow. What's Wheaton's view on that? Are you going to also consider those types of opportunities, like buying some of your smaller peers, or are you solely focused on asset opportunities?
Sure, and we have built models on every single, probably, streaming company out there, because we like to understand what's happening. Now, that being said, when you look at the multiples that these companies are trading at versus the opportunity set that we have in front of us, if we can buy streams at NAV or at a discount to NAV, it makes no sense to come in and pay a 30 or 40% premium for an asset that's already trading at 1.3 to 1.6 times NAV. So, we will likely not be the instigator of any streaming consolidation that's going to happen, because we are still seeing lots of opportunities to stream assets rather than to buy streaming companies. But if somebody does come in and start bidding for these things, we'll have to look at these things strategically. Does it make sense to let this company go to this other company, or does it make sense for Wheaton to step up at that point in time? And right now, thankfully, the market has been rather intelligent. There hasn't been a lot of that consolidation on the streaming side. you know, it really, when you're actually buying a company at 2 times NAV, if you're paying a 40% premium on a 1.6 or 1.7 times multiple, it really doesn't make a lot of sense. There's no way it can be accretive, and we continue to focus on accretive opportunities out there.
Okay, excellent. All right, I think that's close to all the time that we have.
Okay.
And so thank you very much, Hatham.
Thank you very much, Mary. Thank you, everyone. Thank you.